In listening to people on the show, it seems like everything's dire. You know, China's going to crash. The States raised rates too early. There's no growth in Europe. So I think this might be the year of the asset picker rather than the year of the market. Right? You don't say which market's going up. Say which assets are going to do well or which assets have not done well. Things that we think are going to do well relative to others are European investment-grade companies. The dispersion, which is the spread between Europe, between high yield and investment grade, is at all-time wides. Why? Because a lot of companies are losing their ratings. So, you know, I brought a couple of examples we'll talk about in a second. So what we're thinking is commodity prices low, China hard landing or slowing down, bodes badly for investment-grade companies. They lose their rating. They turn into what's called fallen angels. Fallen angels are unique opportunities because they always overshoot to the downside. Everyone sells them. They become non-investment grade, and then everyone says, well, hold on a second. This is, you know, a multi-billion-dollar company, has cash flows, has diversified, you know, sources of income. And then they look at it again and say, if I gave you an example, triple B, what would you think you'd earn in yield? Give me a rough number. Have a guess. Let's see how smart you guys are.
I mean, you tell us.
Well, normally, you know, 1, 2, 3% in the States, right? Investment grade is giving you 2 or 3%. Govies are giving you 1.5 to 2.
Yeah. I would have said 2 to 3.
There you go. High yield, what do you think you should get?
Well,
single B high yield.
I mean, is there 5 on the table?
Well, yeah, 5, 6, 7, depending how, you know, distressed the company is. What if I told you the 2 examples I'm giving you today are going to give you 11%?
Well, let's talk about the 2 examples. I mean,
yes.
We can't tease viewers like this and
not
show them the charts. So ArcelorMittal.
So ArcelorMittal, you know, steel prices down, laying people off, Chorus, that whole merger of the industry, capacity is too large. Not a bad company. We did the analysis. Given the current capital structure, meaning how much debt they have, leverage is high but not that high. However, I caveat this. If prices stay low, and the same with the second one, Glencore, things will get worse. These companies will have to restructure their debt. However, we think that happens in 5 years. So let's look at the graph here. This is the graph of yield. So this is how much you're paid to hold, and I took a 2-year bond. What we think you buy is 2-year investment-grade debt in ArcelorMittal and Glencore. Why? Because they'll be around in 2 years, but they'll pay you 11% to hold this bond to maturity.
But you mentioned the if prices go lower from here, if prices stay low.
Yes.
A lot of people saying that if could come true.
Yes.
And in that case, does this investment position no longer hold? Then where do you
Let's
go?
take the Glencore example, and I'll walk you through Glencore. So in Glencore's case, we said, okay, they've got different divisions doing different things, commodity trading and, you know, commodities. If prices go lower, and we said, okay, let's say prices go 10% lower. If they sell the division they're already going to, the agribusiness, they're going to sell 25%. Even if that happens, we think Glencore's leverage goes to 8 times. That's not investment grade. This is in a couple of years. In 2.4 years, that company will run out of cash the way it is now. If prices stay where they are, go slightly lower. But if you buy 2-year debt, as we see on this chart, you're going to get paid. So what I'm saying is, rather than predict the outcome far in the future, take advantage of the dislocation in the markets and buy shorter-term paper in companies that have the ability to sustain, you know, markets over time.